Hello there. Welcome to the Open here on BNN Bloomberg. Let's get to the big stories we're bringing you from our newsroom. Canada's current account deficit narrowed to just under $10 billion in the third quarter, according to Statistics Canada. The decrease in the gap was mostly due to a narrowing of trade in goods deficits as exports increased during the third quarter, while imports decreased. Investment income and trade in services also contributed to the overall narrowing of the current account deficit. Prime Minister Mark Carney is expected to unveil plans today for a new oil pipeline deal with Alberta. The Alberta government has been negotiating with Ottawa to allow the proposed Pathways Alliance project, that's about carbon capture, to move forward, along with a proposed pipeline to the West Coast. Carney promised to make Canada, quote, an energy superpower, but a 2019 tanker ban is blocking a new pipeline from being built to the north coast of BC. Ottawa has yet to say whether it would end that ban. Rogers Sugar beat estimates on profit and revenue in its latest quarter. The Montreal-based company attributes the numbers to what it calls disciplined execution and consistent demand from customers. The company says it's currently focused on expanding its refining and logistics capacity in Eastern Canada. So the U.S. markets closed today for the Thanksgiving holiday. Let's have a look at the TSX and see how it fared yesterday. And our market breaking through to record highs, boosted, as I mentioned yesterday morning, by the bank stocks. Let's have a look at oil. And oil holding its own right now, but stuck well below that $60 mark, amid speculation that some kind of a deal to end the fighting in Ukraine is on its way. Let's have a look at gold. Gold has been doing well on expectations of another Fed rate cut next month, losing a bit of altitude today. And let's check out the Canadian dollar. Canadian dollar holding its own today above 71 cents US. And finally, Bitcoin. Bitcoin has lost a lot of altitude lately, but it's stabilizing right now above $90,000 US. The U.S. market closed today for the Thanksgiving holiday. This gives Canadians time to pause and reflect on the performance of the S&P 500 and compare it to that of the TSX, and perhaps consider some Canadian stocks. We're joined by Ross Healy, Chairman of Strategic Analysis Corporation. Ross, thanks very much indeed. What's top of mind for you today with the U.S. market closed?
Well, Andy, I'll tell you the truth. I think I'm going to turn on my... There we are. That's a bit better.
That's good. We can see you now. Okay.
I suddenly realized that I was in the dark there. I suddenly, at least I realized in looking at the U.S. market... Oh, sorry. Okay. We're out of fire department things. Oh, come on. Sorry, Andy.
Do we have to break away, Ross? Is something happening? Should we come back to you?
Yeah, we've got a fire alarm test.
We'll come back to you when possible, Ross. Thanks very much. Let's switch over now to have a look at the commodities. Copper of interest here. Let's put up a one-year chart for copper because the anticipated giant demand sparking M&A in that sector. You can see copper up 25% in the past year. Maybe we could put up a 5-year chart for XBM. I often cite this as it's an ETF in Toronto. Often cite this one as a proxy for sentiment in the base metal stocks. And look at that, they are moving up. Classic cyclical stocks, but of course, copper is a special case right now because of the anticipated massive electricity build out. Let's have a look at CEG now, which is Constellation Energy, a major electricity producer south of the border. We have seen stocks such as Nvidia and Oracle come off the boil as people reflect on the massive cost of the AI build out. We'll have a look at CEG in a second. I think we've got Ross Healy back. Ross, thanks very much indeed. We're going to put up a 10-year chart for the TSX Composite now. It hasn't been a bad run lately for our benchmark.
Well, when you compare the valuation of the TSX to both the Nasdaq and the Standard & Poor's, our index is way, way, way cheaper than theirs. Our in price to book terms, we're about half, actually a little bit less than half of the American market, and it looks very much to me as if there is going to be a swing towards Canadian assets, therefore, which are quite cheap, and which you mentioned oil earlier, but oil are banks and golds, and so on. When I look at the U.S. market, what I see is extreme uncertainty. The Standard & Poor's and the Nasdaq have reached back recently at their peaks to their peaks in the year 2000. And
in terms of valuation, Russ?
In terms of the valuation, yes, in terms of their price to book of their valuation, and at that time, the S&P just held up there, and actually it looks as if it was kind of breaking out. The Nasdaq looks as if it tried to break out and is breaking back. I think under the pressure of the downwards move in the AI stocks. So the market, the U.S. market, is at kind of sixes and sevens, whereas our market, I think, is quite clear. It's cheap, and the values are good, and the values are rising, by the way, which I'd like to see. So all in all, I think Canada is a safer place to invest.
I'm just looking here. I mean, we do have very different markets. Excuse me. But over the past 5 years now, our market, according to my Bloomberg screen, when you include dividends, now ahead of the U.S. market with a total return for the TSX of 108%. That's 7 points ahead.
That's right. In a very long-term sense, Andy, if you look at the Canadian versus the U.S. market, there will be periods when the U.S. market outperforms and the period when the Canadian market outperforms. And I think we're moving away from the U.S. market outperforming to the Canadian market outperforming now.
You have some stock ideas for us. Fortuna Mining, Ross, FVI. What attracts you there?
It's first of all, it's a very cheap gold stock compared to most of the other gold stocks. Secondly, it does what I like to see. It has excellent reserves, and the high quality reserves are growing. And when you've got a gold mine, you got to remember that every time you take something out of the ground, if you don't replace it, then your total values are declining. Well, that's not happening with Fortuna. They are expanding, and so when I look at a quality balance sheet, cheaper than the average Canadian gold stock, and expanding reserves, and I think, by the way, in a nice politically stable environment in the Côte d'Ivoire. So all of those things add up, I think, to a very promising investment.
Another, and certainly that stock's had a tremendous run. Another name that's attracting you is Power Corporation, the financial conglomerate.
Or, Andy, had been steadily kind of recommending Power Corporation for the past 3 years to my clients, and for the first two, they just kind of sat there and didn't do anything. And then this year, all of a sudden, it all sort of came together, and Power Corp has done very, very well. It is still, however, very cheap. I wish instead of taking 2 years flat and then 1 year straight up, it had just given me 20% a year. I'd have been happier. But that isn't the way that life unfolds some way. And but the stock, when you look at it at the historical peak on the stock, it still has a nice way to run.
And then finally, Laurentian Bank. It has been a disappointment for investors over the years, but you see upside here.
Well, I do. The Laurentian Bank is very cheap, and this reminds me, of course, a lot of Power Corp. Okay, just sitting there and sitting there and sitting there. Why don't you move? Why don't you reflect those values? You ask the market. Well, I am no doubt that the market will reflect the values, but it's going to take time. And when it does, I think we could see a very nice move in this stock.
Right. What attracts it? What could ignite Laurentian Bank, do you think?
Well, I had thought for some while it would make and by the way, if you look at all the fundamentals of Laurentian Bank, it would make a superb acquisition for another Canadian bank. And I thought with the TD being essentially now shut out of the U.S. market, it would be an ideal acquisition for it. A huge discount from its book value. You put the TD systems in there, and the ROE on Laurentian Bank would just shoot up. It would be an absolute steal. Another possibility, of course, is that an American bank decides that it wants to come into Canada, and this would make a superb platform for that. However, if I go back in history and I look at Laurentian Bank, I see that from time to time it doesn't make any difference whether anybody buys it or not. From time to time, the market just says, "Hey, tremendous dividend, very, very cheap," and up the stock goes. Ross. Now, $42 was the area that people were kind of hoping that the company would be able to sell itself at. Wasn't able to do that, but nonetheless, that is still incredibly cheap. And I suspect that all by itself, the stock is worth a good deal more.
Ross, thank you very much indeed. Ross Healy, chairman of Strategic Analysis Corporation. Coming up, a new report indicates that healthcare spending is outpacing the country's rate of economic growth. More on that next. A new report from the Canadian Institute for Health Information estimates that growth of health spending in Canada will top 4% this year. It's projected to reach almost $400 billion. We're joined by CTV's Scott Hurst. Scott, thanks very much. What is driving this increase?
Yeah, really what we're hearing from this report by the Canadian Institute for Health Information, driving the increase, rising costs becoming a reality, stretching healthcare budgets. Driving the increase include inflationary pressures, along with a growing and aging population. As a new report detailing health spending in Canada emphasizes the need really for innovation in how care is delivered. So let's break down some of the numbers and then put them into perspective. In 2025, healthcare spending is projected to reach $399 billion, and the cost to deliver care is expected to outpace economic growth. And so those are the numbers from the report, and putting it into perspective, in the current environment, simply boosting spending is increasingly difficult. And really, it's not just about throwing money at the problem, meaning spending alone cannot address the challenges impacting patients and care providers. So investments in healthcare, according to the report, need to be made where they can truly make a difference, and arguing without innovation, spending alone, Andrew, will not address the current challenges facing our healthcare system as costs are rising.
It is fascinating. We know it's not just in Canada. Obviously, America's struggling with this as well. And just remind us, where are the big increases, or where is the heavy spending in the health system?
Yeah, there are a couple big ticket items when it comes to spending in the healthcare system, and there's nothing bigger than hospitals themselves, eating up the biggest chunk of healthcare spending in this country at about 26% of total health expenditures in 2025. So that is by far the biggest expenditure. But there are really three expenditures that eat up about more than 50% of overall spending. The other two include physicians at just around 14% and drug expenditures, Andrew, coming in at about 13%.
Scott, thank you very much indeed. Really appreciate it. Scott Hurst of CTV News. Up next, why Bloomingdale's thinks it can bring back the golden age of the iconic department store. There are high stakes for retailers this holiday season. Burberry and Bloomingdale's want to attract buyers amid inflation and tariff pressures. Bloomingdale's CEO Olivier Braun says the company is bringing back the golden age of the iconic department store, while the Burberry CEO Joshua Schulman says they're the only luxury brand of scale with a, quote, uniquely British heritage. The two CEOs spoke to Bloomberg's Romain Bostic in two separate interviews.
'Tis the season for holiday shopping. And despite U.S. inflation holding above historical averages for 4 years and tariff tumult upending global supply chains for the past 5, the CEO of Bloomingdale's, he says consumers are ready to spend.
Actually cautiously optimistic. The trend over the past few months has been amazing at Bloomingdale's. We feel pretty strong about our customers' feedbacks, about our partner feedback, about the current trend that we're experiencing. And we're building such a great event for this holiday season that we're convinced that it will resonate very, very well with the customer.
And he's not kidding. Bloomingdale's is betting big on the holiday season. From personalized stockings to a Labubu tree and even a visit from a very familiar face. All in an effort to reinvigorate the department store shopping experience with emphasis on experience.
This is what we're really focusing on right now, is bringing experiences. Not only great products, but really bringing experiences that create the conditions of relationship. People want to connect, and we want them to connect at Bloomingdale's.
The Bloomingdale's flagship store on the east side of Manhattan has for decades been one of the crown jewels of New York City retail. But behind that grand facade was a company struggling to adapt to the times. Now, after years of sales declines, Bloomingdale's, a division of parent company Macy's, has found its stride, posting 4 consecutive quarters of same-store sales growth heading into this holiday season. And Bloomingdale's has reason to be bullish. The National Retail Federation estimates that 44% of consumers will do their holiday shopping at department stores this year. And Olivier Braun, he's confident it will extend his company's rebound.
It's really about rebuilding the next golden age of Bloomingdale's. We heard a lot about Bloomingdale's in the 70s, in the 80s, where it was really the place to go. And actually, right now what we're trying to build is really recreating this destination, Bloomingdale's. And we're an icon, but we have to reinvent ourselves. It's also what Josh is doing with Burberry. This is what we're aiming to do at Bloomingdale's, with one key focus is actually bringing back customer experience, customer delight in our stores, and really based on building relationship connections, etc. This is what is making us different.
The New York retail giant joining forces with the iconic brand and plaid, a relationship that goes back decades.
This is a relationship that Burberry and Bloomingdale's have had for over 70 years. So it's the perfect place to bring our timeless British luxury brand expression to all of Burberry customers and all of Bloomingdale's customers, and frankly, to all of New York City.
To celebrate that partnership in the spirit of the holiday season, Bloomingdale's has literally wrapped their flagship store in a giant Burberry scarf.
It was a little bit emotional, I have to say, seeing this uniquely British, uniquely Burberry, uniquely Bloomingdale's story come to life on the streets of New York City. There's only one New York. We are really thrilled to open our arms and wrap a scarf around New York City and bring a little bit of warmth and joy for this holiday season.
And since Joshua Schulman took over the helm of Burberry in July 2024, shares of the London-based brand, well, they've rallied 50% as the American-born CEO leans into the brand's Britishness.
There are many luxury brands that have wonderful, beautiful heritages, and they celebrate their heritage, whether it's Italian or French. But Burberry is unique because we are the only luxury brand of scale that has a uniquely British heritage.
Burberry, remaining true to its roots, is highlighting the products that cemented its status in the luxury space, while also branching into new directions.
Everyone knows and loves a Burberry scarf, which is the perfect gift for anyone in the family, around $520. But we have a range of products. You know, you can buy a candle for $130 to one of our iconic made in England trench coats for $3,000. Burberry has always been at its best when it is a luxury brand with broad universal appeal. What we love about Bloomingdale's is they really share our values. And this is a brand that also has broad universal appeal.
A recent report by JP Morgan shows that consumer demand for luxury goods in the U.S. is largely held up despite the economic headwinds. The S&P's Global Luxury Index, which tracks 80 of the biggest names in that space, including Burberry, Prada, Dior, LVMH, that is showing no sign of slowing down.
The momentum that we're seeing didn't start for holiday. It started, months and years ago, and we just keep the pace right now. So we have new events, we have new marketing activation that are coming, we have new brands coming in the store right now, we have new ideas. So I think it's just a kickoff of what's coming.
And though Bloomingdale's has only just unveiled their 2025 holiday display, they're already looking ahead toward the future.
We already know what's going to happen in 2026. We're already working on what's going to happen in 2027.
Opening bells coming up next. American markets closed for Thanksgiving. Here's the opening bell at the TSX. And Dina Copper Corporation is doing the honors. It's time for the first 15. And let's see how the TSX is opening right now. Remember, it hit a record high yesterday, slipping from that in early trading, but barely. Our market, of course, beating the U.S. benchmarks this year, fueled by banks, fueled by gold, fueled by copper stocks. They haven't hurt either, but we're down slightly from yesterday's record high close. So far in calendar 2025, the TSX, which is now actually the markets are up 2 or 3% now in the past week. But year to date, the TSX has jumped 26%. And the S&P's been quite a laggard. It's up only about 16%. The NASDAQ, so far this calendar year, up just over 20%. A couple of stocks of interest. Let's have a quick look at West Fraser. We're going to be hearing more about this from Lindsay Biscaya shortly. But the federal government announcing hundreds of millions of dollars in support for the beleaguered lumber industry. And let's have a quick look at Brookfield Renewable Partners, of course, a player not just in wind and solar, but also nuclear. BMO, Ben Pham, the analyst there, resuming coverage of Brookfield Renewable with a buy rating after a $650 million equity issue. And this company, of course, seen as a play on the build out of electricity capacity south of the border and in countries around the world. Let's get some more on stocks of interest. We're joined by Jeff Morgan of Bloomberg, and he is deputy team leader for the Bloomberg News Equities team. Jeff, thanks very much for coming on the show. You have financial stocks on your radar, starting off with EQB.
Yeah, EQB is going to be a stock that's worth watching today, even though we're not seeing a lot of big conviction moves so far in the early trading session here. EQB had its price target lowered at TD. Analyst Graham Riding came out this morning and lowered the price target to 96, which is near a street low. Previously, it was $105 Canadian a share. What they're seeing here is more conservative loan growth for EQB going forward. The analyst said that they may have been too optimistic previously in several areas. Those include provisions for credit losses, and those include net interest margins. The TD still rates this stock as a hold, but now has an earnings per share target of $1.93 in the fourth quarter. They previously expected the bank would earn $2.41 a share in the fourth quarter. So definitely a moderation of expectations here for EQB, not only in the fourth quarter, but this is near a street low price target on the stock, as I mentioned.
It's fascinating because we've seen quite a few of those non-conventional lenders, as you know, worries about rising defaults or provisions. Maybe you could have a quick look at PRL, Propel Holdings, and their sort of AI. I believe they use AI in working out who's creditworthy. Or Go Easy, GSY. Those stocks have come down a lot as well.
Yeah, it'll be worth watching over the course of the day here. As I said, not so many conviction moves so far. The biggest move I'm seeing in the TSX up is about 1.8% and down is about 1.8%. So it'll be worth watching. We'll be kind of hyper tuned to analyst actions over the course of the day in absence of big moves right now.
Another stock you're watching is Badger Infrastructure. They're the ones, I believe, that use the water to dig holes. It's less destructive.
That's right. Hydrovac and non-destructive excavation, I think is how they call it. So Badger Infrastructure was initiated with an outperform rating at National Bank this morning. Price target of $84 is very close to a street high. I think the highest price target on the street right now for this stock is $88, and that's at Stifel. So National Bank coming out this morning, as they said, Badger already has a 25% share of the North American market and is targeting double-digit top-line growth. So they see some continued growth ahead, a lot of potential here, at least according to National Bank. Pushing the valuation higher, they think is warranted. As I said, $84 is not only a street or close to a street high price target, it's also 16% higher than the stock's been trading at. So definitely another one worth watching here.
Jeff, thanks very much indeed. Bloomberg's Jeff Morgan. Coming up, we are going to zero in on the performance of Canadian energy stocks. They have been hot performers compared to their U.S. counterparts. Ryan Bushell is up next. Ottawa has thrown the beleaguered softwood lumber industry a bone, with the Prime Minister, Mr. Carney, announcing new supports for the lumber producers and the steel industry. CTV's Andrew Johnson filed this report.
It's a company that wears Canadian pride on its sleeve, but Leslie Forest Products in Delta, BC isn't sure the federal government has its back.
It seems like they're more focused on, the issues back east, whether it's energy or, the auto sector.
James Sangera says the federal measures to help the industry announced today won't make much of a difference here, but he knows what would.
Work out a deal, reduce the duties.
Sangera says his family's softwood lumber business has constantly adapted to survive, but this year has been a challenge.
My dad's never laid anybody off in our 52 years that we've been here. He's always kept the mill running.
The softwood industry has been hammered by a combination of U.S. duties that have tripled and new Trump tariffs announced last month.
Profit margins are so low. Instead of manufacturing fencing and decking out of this wood here, the company says it's sending the wood down to the U.S. unfinished and doing the work there to avoid some of the tariff hit.
That wood that we shipped down there, that would have kept us busy for a couple weeks. We're scrambling to find work just to keep our guys going until Christmas.
The message from the mill is being echoed by advocates who also feel the industry doesn't get the attention it deserves.
I think the announcement today was basically for steel. I think it'd be great if I was in steel. I feel like we're in the moment of Sophie's choice, where softwood lumber is going to be the child that's left behind.
They hope that's not the case here, and 2026 will bring some badly needed stability. Andrew Johnson, CTV News, Delta, BC.
Yesterday on Market Call, we were joined by Martin Cobb, Senior VP Equities at Lawrence Steinberg Wealth Management. The topic, US and Canadian equities. His top ideas were Kenvue, Starbucks, and CN Rail. And today on the show, it's Mike Philbrick, CEO of Resolve Asset Management. He'll take your questions on exchange-traded funds. Up next, the Alberta government is expected to sign a memorandum of understanding with Ottawa on resource development. That's expected today. More after the break. Okay, so U.S. markets closed today, but let's have a look at the trading pattern for Alibaba and Baidu yesterday, because there's an interesting political story here. The U.S. Department of War, or at least the Pentagon, concluded that Alibaba and Baidu, both Chinese e-commerce giants, should be added to the list of companies that help the Chinese military. Now, that's from a Bloomberg report citing a letter to Congress. And apparently that letter was sent about 3 weeks before the US president and the Chinese leader agreed to a broad trade ceasefire. BYD, the electric vehicle car maker, also on that list. It wasn't clear, though, at this stage, whether those companies have been included in the Pentagon's official 1260H list. It carries no direct legal repercussions, apparently, but it serves, as Bloomberg puts it, as a warning to U.S. investors. We know that U.S. and China locked in a battle for global tech dominance, and the Chinese military, a major player in technology, as they are, of course, in the United States. The U.S. military is a huge sponsor of research, and stuff that gets designed for the military often finds its way into civilian applications. But it's interesting that two e-commerce companies you'd think would not be directly connected to the Chinese defense sector are being cited by the Pentagon. Now, of course, some of this could be rhetoric. The Deputy Defense Secretary, Stephen Feinberg, who's informed the lawmakers of that warning from the Pentagon, is quoted as saying the department has identified 8 entities it has determined are Chinese military companies. Now, in a statement, Alibaba says there's no basis for putting us on that list. We're not part of any military-civil fusion strategy, and we're not even involved in any business related to U.S. military procurement. And Baidu, for its part, saying our products are for civilian use. There's no credible basis for adding Baidu to the 1260 list or any other group of restricted companies. So interesting, though, that the concerns in the United States, apparently, of course, anything involving military you have to take with a grain of salt. Deception is central to any military strategy, but apparently the U.S. military, the industrial complex, wary of Baidu and Alibaba. Just looking here at Chinese stocks, they have lagged other major markets this year. The CSI 300 is up only about 15% this year, whereas Hong Kong is up more. Hong Kong's done better, 29%, but the CSI 300 of mainland stocks hasn't done as well. And one of the worries here, of course, is that China is still going through what could be a painful transition to a less export-oriented industry. Okay, let's get back to this political story in Canada. The Alberta government expected to sign a memorandum of understanding with Ottawa on resource development. That's set for Calgary. Let's get more from CTV's Annie Bergeron-Oliver. Annie, thanks very much indeed for joining us. Can you tell us what we know so far, please?
Hi, Andrew. Well, we know that this announcement between the Alberta government and the federal government is expected to happen in Calgary in just a few hours. And as you point out, the two are going to sign a memorandum of understanding. Now, if you ask the Prime Minister, he says it's more than just a framework for a pipeline. He says this is about removing our reliance on the U.S., shifting our exports to other markets, specifically in Asia, and becoming a stronger, more independent country. If you talk to a lot of other people, though, they say, look, this is essentially going to be an agreement that sets the groundwork for a pipeline. The sources are saying that essentially a pipeline will be approved by the federal government. They're going to put their political capital behind it, but under certain strict conditions. For example, the Alberta government will have to get the BC government on side and coastal First Nations, who both are strongly opposed to the pipeline. The federal government is also supposed to say if the Alberta government can do that and if there's going to be some type of Indigenous co-ownership of a pipeline, then they are willing to carve out and lift certain aspects of this controversial tanker ban. The Alberta government and those in the oil and gas sector say that no pipeline can really be feasible or viable without a lifting of the tanker ban because it limits how much crude oil can get to market. And so they say without an ability to transport the oil to Asian markets, there's not really much point in a pipeline. But environmental groups, coastal First Nations, and the BC government say there's too much of an environmental risk. They don't want the pristine ocean in between Vancouver Island and the tip of Alaska to be at risk for an oil spill that could be potentially devastating.
And just remind us, where is the BC Premier positioning himself in all this?
He's saying no, that he does not want a pipeline. He says that not only is it something that he doesn't support, especially lifting anything regarding the tanker ban, but he says, look, this is going to put at risk a lot of what he calls fragile relationships with coastal First Nations who have approved other energy projects and who are working with the BC government in other areas. He says a lot of coastal First Nations are not okay with the development of resources, in large part because they're worried about what this means for the ecosystem, what it means for their communities with the potential of a spill or elsewhere. And he says that approving this pipeline is going to be putting those very fragile relationships at risk. Now, what's interesting here, Andrew, is that the federal government does ultimately have jurisdiction over federal projects like a pipeline. So technically, the federal government could say, look, we can build this pipeline without the approval of First Nations and without the approval of the BC government, though the court courts have said that there is a duty to consult the First Nations group. So it'll be very interesting to see what the wording is in this memorandum of understanding, because again, BC has said they don't want this pipeline. A lot of coastal First Nations groups have also said they don't want the pipeline, but Alberta does. So that'll be interesting to see how this wording is actually in there. So really today, the devil is in the details, Andrew.
I imagine the civil servants are all there with their heads huddled over us trying to work out, and they've probably got the lawyers on speed dial as well. Thanks very much indeed. Annie Bergeron-Oliver of CTV News. Coming up, we are going to zero in on the strong performance of Canadian energy stocks. Our guest says he continues to marvel at the strength of Canadian energy stocks, especially exploration and production names, in light of the very weak performance of crude oil. It's a really good topic. Let's bring in Ryan Bushell, CEO and Portfolio Manager at New Haven Asset Management. Great to see you. You have some pretty striking charts for us, Ryan. Thanks for joining us. We'll have a look at those in a sec. But let's maybe have a look at a 5-year chart for XEG, an ETF that tracks the energy producers. It is amazing how they've held in.
Yeah, for sure. And thanks again for having me, Andy. But the performance of Canadian energy stocks, it used to be when the oil prices went down, we got hit even harder. That was because of differentials blowing out and our production in Canada being seen as high-cost production relative to what was cheaper, shorter cycle U.S. shale. And that trend seems to be reversing. So, today it's interesting topic with the potential pipeline announcement coming out of Alberta. I think it's just an interesting time to examine Canadian energy stocks, both on the oil and gas side, because I think the dynamics that are happening in oil that have happened over the last couple of years, I think are poised to repeat in gas over the coming few years.
You have a chart here showing a 2-year total return for a bunch of our energy names. Oil has dropped, but they've been strongly positive.
Yeah, and so you can see on the chart some of those names up 80%. And I didn't just include the E&Ps in this chart. I wanted to also include the infrastructure names, TC, Enbridge, and Pembina, which have also been strong over the period, just to show that really the whole Canadian energy ecosystem has performed positively, again, at a time where typically when oil prices go down, especially down as significantly as they have, they would get hit harder. The other thing that's interesting about that is I think it's pretty easy to chalk it up. People have made this story on a year-to-date basis and said, okay, change in government, we're getting the announcement in theory out of Alberta today, chalk it up to, it's just that simple, that change in government has changed the attitudes. But actually it's gone back a longer period, and I think that speaks to some larger dynamics at play.
And Trans Mountain, that's been interesting. Since the Trans Mountain expansion opened in May of last year, oil has dropped, but similar pattern. Our energy stocks have held in just fine, beating American counterparts.
Yeah, and I don't know if you've got my second chart up on the screen there. And so that is one of the larger dynamics. So to me, there's kind of three things at play here. You've got Trans Mountain has put a floor under the price of oil for Canadian producers that has reduced that differential to just the transportation differential to the Gulf, which is about $10. It had been as wide as $50, say, in the past decade. So that's one major key factor. The second factor we've talked about is the government change, sentiment becoming more positive. And the third factor is kind of under the surface and a little bit more ambiguous, but it is what is happening with U.S. shale. And again, on this chart, it shows that U.S. producers are down over this period while Canadian producers are up. And I think it speaks to some money potentially rotating back to Canada for the two reasons we listed earlier, but also potentially concerns about the inventory depth of U.S. shale. Yeah,
that's the thing with the shale. It runs down pretty quickly. Yeah, and we are blessed in economic terms, in any case, with those oil sands. They last for decades.
Yeah, that's right. And so you're seeing, again, capital finally feeling maybe somewhat comfortable to come back to Canada. And so it speaks to, we're in a questionable crude environment going forward. If Russia and Venezuela get solved to the point where more production comes on from those two countries, that's going to be bearish for oil prices. So I am not necessarily making a bull case for the commodity, but it does show that when we typically had a higher beta to the commodity, especially to the downside, meaning Canadian oil stocks would underperform when crude went down. Now they're actually showing less beta, and that cash flow discipline that was imposed on them over the past decade, I think, has put them in good standing with the international investment community, where we are seeing some dollars come back. And, again, we've got the AI trade as well, where energy is now down to 3% of the S&P 500. If that rebalances at all, Canada should benefit. The last thing I wanted to get in just before I leave is on natural gas, because I think similar dynamics could happen in natural gas for Canadian producers, whereby we don't necessarily see a hugely positive commodity story, but we see a floor put under Canadian prices with export capacity poised to come online. LNG Canada now online, but maybe phase 2, wood fiber, Cedar LNG, and some other projects going forward into the future.
Have seen something of a rally for U.S. natural gas lately. Maybe we can put up a 5-year chart. But it has been disappointing, hasn't it? I mean, this year, Alberta natural gas, in theory, going negative at times.
Yeah, and to the chart I put up earlier, you can see Tourmaline being the worst performer of the major Canadian oil companies on that chart, and that does speak to the dynamics in Western Canada related to Western Canadian, really soft Western Canadian pricing for gas, which again is still currently landlocked by the fact that we don't have enough egress capacity, meaning transportation capacity, export capacity out of Canada, and that is changing rapidly here. So, again, that's where I think you could see a similar dynamic happening in Tourmaline, say, over the next 3 or 4 years, or ARC Resources, or any number of Canadian gas producers, whereby the commodity doesn't necessarily perform, but the stocks start to perform because Canadian prices are getting better.
Finally, we've less than a minute, but it's a bit of a tricky one for Mr. Carney, isn't it? Placating BC, but perhaps expressing support for a pipeline to the northern BC coast.
Yeah, and I think that'll be difficult to get done, even if there is a big announcement today. So I wouldn't be trading that news, so to speak. I wouldn't do it anyways. But it will be interesting to see what actually gets done. Right now, there are some pretty nice brownfield expansion opportunities. Trans Mountain could be expanded a little bit further and sooner than many would have expected. Enbridge has got a transportation. They just had an open season on about 100,000 barrels a day going to the Gulf that was well subscribed and could do another 250,000 barrels a day going forward. So there are some smaller incremental expansions that I think will tide us over. I don't necessarily think we need a major export pipeline in the next 3 or 4 years, say, but it is nice to see that we're thinking ahead finally.
Ryan, thanks very much indeed. Ryan Bushell, CEO and Portfolio Manager at New Haven Asset Management. Coming up, is tech overvalued or just misunderstood? Eric Jackson. We'll hear from him shortly. Hey there, welcome to the second hour of The Open right here on BNN Bloomberg. Let's get to the big stories we're bringing you from our newsroom. The Prime Minister, Mr. Carney, is expected to unveil plans today for a new oil pipeline deal with Alberta. The Alberta government has been negotiating with Ottawa to allow the proposed Pathways Alliance project, which is focused on carbon capture, to move forward, along with a proposed pipeline to the West Coast. Carney has vowed to make Canada a, quote, energy superpower, but a 2019 tanker ban is blocking a new pipeline to the BC North Coast. Ottawa has yet to say whether it would end the ban. Rogers Sugar posted profit and revenue in its latest quarter that came in above expectations. The Montreal-based company says the results were driven by consistent demand from customers, and it's focusing on expanding refining and logistics capacity in Eastern Canada. The federal government and Prosper Canada are investing more than $48 million in 97 community organizations across the country to give financial support for those with low to moderate income. The funding will be issued over the next 4 years and will provide services that include tax filing, benefit assistance, financial education, coaching, and counseling. And there's a look at the TSX slipping from yesterday's record high, but certainly beating the American market nicely. And as I say, closing at an all-time high yesterday. The American markets closed today for Thanksgiving. Big traders right now in Toronto, including Great-West Lifeco, up slightly. That stock's been hitting record highs. Royal Bank flat. Hard to see any big movers among the heavy traders right now. Bank of Montreal and Bank of Nova Scotia, little change, but the bank's dominating trading in dollar value terms right now. And let's have a look at oil. The worry here, of course, is that the world is headed into a growing surplus of the black stuff as we move towards 2026. The market, though, standing by for the next steps on a possible ceasefire deal in Ukraine. And let's check out gold. Gold slipping this morning. The prospect, though, of Kevin Hassett, a Trump ally, taking over as head of the Fed has investors expecting lower interest rates, and that's seen as good for bullion prices. And finally, let's have a look at our dollar, the Canadian dollar. Little change right now, about 71.2 US cents. We've heard warnings that tech mega caps are fully priced and there are fears of an AI bubble. But our guest says tech isn't overvalued, it's just misunderstood. We're joined by Eric Jackson, founder and president of EMJ Capital. Eric, always great to see you. Thanks very much indeed. What do you think is the big misconception about tech right now?
Hey, Andy, I think the biggest thing is the elongated S-curve that's taking place with AI investment right now. People are just impatient and constantly wanting to see the immediate payback of these billions that they see going out the door, especially from the hyperscalers into chips. And the truth is that it's just nothing's wrong. It's just taking longer from the time you buy the chips and you put them in the data centers for the enterprise customers to actually build the applications, to map onto their data sources in their own enterprises, and to show the payoff. So, you know, take a name like Palantir. I mean, they typically get raked over the coals for being overly expensive on a forward price to sales basis. I think people are ignoring the fact of the contract growth that they have under contract and how quickly those enterprise accounts are growing. And that all comes before they recognize the revenue down the road. So the billions in revenues are coming. These hyperscalers do not spend billions willy-nilly. And I think that's what the bubbleistas are missing.
When you refer to an S-curve, what's that, Eric?
Well, it's, you know, every technology typically goes through this period of kind of slow early adopters, you know, buying into new technology, whether it's mobile phones and mobile ads that go on those phones, or something like AI. And then suddenly the whole crowd catches up and things start to take off. So, you know, we sort of see the same dynamics in adoption of ChatGPT or adoption of some, you know, NVIDIA GPU chips. And so the question is, like, from a revenue perspective, like, how quickly are we going to see the ramp up in revenue? It's coming. We're just still at the very early stages where the ski slope is just, you know, tacking up. But don't, you know, make no mistake, the black diamond steep curve is coming.
And you do say the big prominent AI names may be fully valued, but the supporting players, such as the electricity generators, there's plenty of opportunities there.
Well, no, I would even like point to an Nvidia. I mean, they've been in the spotlight, with Michael Burry taking shots at them recently. If you look at their historical kind of forward price earnings multiple, it's actually below the mean of where it's traded over these last 5 years. And so even a name like that, I think, is sort of undervalued and still underappreciated. I think the market is just can't wrap its head around the sheer magnitude of these quarterly numbers that they're posting, that they just can't imagine that there's another gear for them to shift into and start accelerating even more, because it's unprecedented for a company. So a name like that, though, I think is still cheap, on a relative basis to where it's traded in the past. And a Palantir, even though like this, people can't believe these like price to sales numbers. Again, it's like a slow moving curve, and suddenly like these enterprise customers that they continue to bank are going to continue to grow. Energy storage names, though, names like Iron and Cipher, which I own, that are critical parts of, building out all the AI data centers that we need. Again, like, those have been cut in half in 2.5 weeks in November. So you are getting a significant discount in some of these names. And now, like, some of them have rallied back furiously this week. So, if you miss it, and if you sort of sit back and say, oh, I'm not going to catch a falling knife, sometimes you can miss. Like, Cipher, for example, has had a 3-day 42% positive rally just this week. So the violence, swings back up, can really take some people's heads off.
Okay, we're going to take a break. Eric has very kindly agreed to stick with us for a second block. Always great to have more time with him. After this, we'll find out what his clients are most concerned about, and we'll hear about some stocks that he's been buying. We're back with Eric Jackson. He, of course, is founder and president of EMJ Capital. Eric, thanks very much for giving us the extra time. Tell us one or two concerns clients are expressing to you right now.
I think it's been the volatility in rates and the stubbornness in the rates coming down, and sort of the Fed's fixation on higher inflation. When's that going to come down? And just in the month of November, just the magnitude of some of the drops in some of the small cap stocks. So we mentioned Iron and Cipher just in the last segment, and so I think just a lot of people they buy into some sort of long-term multi-year thesis, like saying that, oh, these names are the sort of picks and shovels of the build out of AI, and I believe they could 10x, 20x, 100x in some cases. But then when that short-term volatility comes and you see some of these names that you hold in your portfolios, that, Iron and Cipher both basically dropped, I think, 47% from November 4th till 2.5 weeks later. And so that's difficult for a lot of, retail investors to stomach. And I try to, say that, like, unfortunately in tech investing, that's the feature, not a bug. Even a name like Apple had something like 6 drawdowns from 1981 until they introduced the iPhone in 2007 of 50% or more. And then even after the introduction of the iPhone, they've had 4 more drawdowns between like 20 and 35, 40%. So that's the granddaddy of tech. And so in these smaller cap names, the moves down can be even more vicious. And unfortunately, you just either have to ride it out. Because if you try to time the market and jump out and think you're going to jump back in, more often than not, you're going to lose more money that way than if you just stick to your guns.
You just give us a bit more on a couple of those names you mentioned. IREN, IREN. What are they all about, Eric? Just remind us.
So they're building from the ground up. They're buying the real estate out there in geographic locations, including, by the way, Prince George, BC, but also like West Texas, where they think they have like a cost advantage, like a local power operator. They can negotiate, a fixed cost for the foreseeable future to build out an AI data center. And so they're taking on that risk. They obviously believe that AI is not in a bubble, and it's here to stay. And so then once a data center is built out, sometimes they're buying the chips from NVIDIA to power it up, and they're flipping on the power. And then they're saying, to the hyperscalers of the world or the oracles of the world, hey, who wants to access our data centers? We've got the power, we've got the chips, we've got the actual physical data centers. And they're basically, it's a game of musical chairs now, where these hyperscalers, they need access to that energized data center source now, not in 3 years from now. And so the people who have kind of thought ahead and built these things out are sort of sitting in the catbird seat. So an Iron and a Cipher have basically morphed from being just a Bitcoin miner a few years ago to taking their know-how of how to build these data centers and kind of positioning themselves at the front of the queue to kind of take orders and power kind of the next generation of AI. So they're referred to as neo clouds. So Iron and Cipher have 3 gigawatts each of these kinds of data centers coming online in the next year. So that's what makes them more interesting, in my opinion, than some of the other players trying to kind of maneuver into this space.
And just broadening it out here, a stock you've long been involved with, Open Door, that you have liked the look of. Do you still favor OPEN?
Yeah, it's 10x since the summer, and I think it's still a potential 100-bagger from here. What's most interesting for the Canadian audience is that the guy who was the COO of Shopify, who basically had to do nothing, just sort of stick around, and whenever Toby steps up to executive chairman, this guy Kaz Nejatian was in line to become the next CEO of a $200 billion market cap company today. He decided to quit and take the job as CEO of what was then a $3 billion market cap company. Now, why would he do that? I think it says something about the challenges that Shopify faces in the AI age. And by the way, this is their most important week of the year right now. But it also says something about how well positioned Kaz thinks Opendoor is to kind of disrupting that whole real estate market using AI. You won't need a real estate agent anymore. You won't need to do showings of your house anymore when Opendoor really rules the world, Andrew. So it's very interesting from a bunch of angles. Obviously, home ownership, cost of homes is a crisis around the world, in Canada, in the U.S. And so Kaz is looking to kind of make Opendoor the Amazon of real estate: faster, cheaper, more price certainty of selling your house when you'll get the money in hours instead of weeks.
Eric, I think we'll have to jump. Thank you very much. It's always great getting your insight.
Great to talk to you.
Eric Jackson, founder and president at EMJ Capital. Coming up, today's ETF report. We're putting the spotlight on an ETF that plays the TSX Completion Index. That is essentially a vehicle for betting on smaller shares in Toronto. We'll be right back. We've heard a lot of guests on BNN Bloomberg saying that investors should think about small and perhaps mid-cap stocks if they're wary of the valuation of the big run-up for the major names. So we're focusing today on an ETF in Toronto, and it hasn't got the most exciting name, but it plays the Completion Index. It's from iShares. It's called the iShares S&P TSX Completion Index ETF. And the idea here is with XMD, it tracks this so-called completion index, which is all the stocks in the composite that aren't in the TSX 60 of blue chip stocks. And certainly it has been doing well lately. XMD, over 1 year, as you can see, has jumped 33%. Now, let me just compare that. Over 5 years, it's pretty close to the broad market. Both have returned pretty similar. Hang on, I don't have that data for you right now, but pretty similar. But over the past year, the Completion Index ETF has definitely outperformed. And its holdings are interesting. Let's have a look. Celestica shows up. Now, you might say, well, it's Celestica. It's no small cap, but it's not in the TSX index. We know Celestica has been a rocket ship. Fairfax has done very well. There's RB Global, Pan American, silver producer in Alamos. So those are the top holdings at the latest report. Over 5 years, maybe we can put up a 5-year comparative chart. both the TSX and the XMD, the Completion Index ETF, have returned about 108% to investors. So very similar. But over the past 1 year, boosted, of course, in large measure by Celestica, XMD is up total return 35%, whereas the broad TSX, which would be, of course, including the 60 as well as the completion index stocks, has a total return of only 26%. So over 1 year, XMD total return of 35%, and the TSX total return over 1 year of 26%. But interesting, you've got a no muss, no fuss way of buying into the stocks that aren't in the 60 there. One option for buying smaller cap stocks. We're also watching the steel industry today after the Prime Minister's announcement yesterday. There's a slew of new measures aimed at protecting the steel and softwood lumber industries. Let's get more from our own Lindsay Biscaya. Lindsay, thanks for joining us. Could you start off with softwood lumber? What is the government doing in that area?
Yeah, sure. We will start off with softwood lumber. So the government providing $500 million each to two different programs that have really been helping to finance the softwood lumber industry across Canada. It's one of those industries, of course, that's been hit so hard by these tariffs, by this trade war. And so that's really the main thing that the federal government is doing in terms of softwood lumber, providing more financing on top of some financial aid they've already provided. The CEO of the Forest Products Association of Canada has been speaking to the media and saying this is a step in the right direction. They feel that the federal government understands the urgency required in this field, but that this is not a long-term solution. But we've also been hearing from some industry representatives from the U.S. as well, saying the support risks exacerbating trade disputes. And there is some concern that this could result in the U.S. government actually collecting those subsidies at the border instead. So just like always, when dealing with this administration in the U.S., the Canadian government has to be careful in terms of where they tread here. But for the most part, within the industry in Canada, most are saying that this is a step in the right direction. In terms of companies we're watching, Canfor will be watching for today. It seems as though when it comes to softwood lumber industries or companies that deal with softwood lumber in Canada, share price is not exactly moving that much at the moment. Canfor, West Fraser is another one, just up and down ever so slightly. Not as much movement as what we've been seeing in the steel industry, where we've been seeing some companies really profiting already from the news that was announced last night.
Let's have a quick look at Algoma Steel, ASTL. They have already had government support, but it looks like there's fresh measures in place here.
Yeah, fresh measures, 25% tariff on $10 billion worth of steel products. The federal government also cutting steel import quotas. And that number depends on whether these countries have free trade agreements or don't with Canada. So there's different numbers in terms of whether you do or don't. But yeah, look at Algoma Steel. Up today, I believe I saw it higher than this at the opening bell this morning. Algoma Steel was climbing.
Maybe we'll put up an intraday.
Maybe. I mean, it definitely is benefiting from this news, but it's also benefiting from a report from RBC because we have been getting some analysts commenting on this. James McGarrigle of RBC Capital Markets, he says these moves are a positive for the domestic steel industry. He believes the Canadian market will be in a position of oversupply, though. But when it comes to the government's plan to reduce freight rates to interprovincial steel transportation, right, so we can have more interprovincial trade, that's something Mark Carney's been talking about from the beginning. He said that this should increase demand for Canadian steel and make Ontario steel more competitively priced. And this is why I think Algoma Steel, that share price going up today, he says he expects to see Algoma have an upside in terms of earnings next year, and that's particularly because of the Buy Canada policy on steel plates as well that the federal government implemented.
Lindsay, thanks very much indeed.
Thank you.
Lindsay Biscaya. Okay, up next, we are going to put the spotlight on Canadian fixed income and find out why our guest is bullish on Canadian bonds. That's ahead. The Prime Minister is expected to unveil an agreement with Alberta that could clear the way for a new oil pipeline. The Alberta government has been negotiating with Ottawa to allow the proposed Pathways Alliance carbon capture project to move forward, along with a proposed pipeline to the BC coast. The agreement could reset the relationship between the two levels of government. Canada's current account deficit shrank to just under $10 billion in the third quarter, according to Statistics Canada. Apparently, there was a narrowing of the gap as exports increased while imports fell. Investment income and trade in services also contributed to the overall narrowing. Sportswear firms Anta Sports Products and Li Ning are among those exploring a potential takeover of the German sportswear brand Puma. As a result, Puma shares are surging. Bloomberg says Anta is working with an advisor to evaluate a bid and could team up with a private equity firm. If it moves forward, Japan's ASICS is also in the mix. And American markets are closed right now. We shouldn't be showing the S&P. That could be the future for the S&P. The TSX, though, up marginally, pushing into new record territory for the Canadian Equity Benchmark Index. Our guest plays Canadian fixed income all day, every day. He says that sure, economic growth is slowing. Debt levels, both public and private, have been rising. Nevertheless, he sees opportunities in Canadian bonds. Konstantin Bloomberg joins us now, head of fixed income and portfolio manager at Mackenzie Investments. Konstantin, always great to see you. Thank you very much indeed.
Likewise.
Of course, bond investors take a different view of economic growth. Sometimes slow economic growth is good for bond prices.
That's right. Yes. So, that is behind my broadly more bullish view on Canadian fixed income, because I do think that the Canadian economy is struggling, unfortunately. The headwinds that we're facing are significant, and those are from housing. I see Toronto, Vancouver more as the epicenters that will maybe radiate outwards to other parts of the country, as opposed to those being completely independent markets. So housing market is in trouble. We have immigration, as we probably all know, having slowed down significantly. That is a meaningful contributor to growth that has broken away. So the job market is somewhat soft. So you have a bunch of headwinds that the economy is facing. Mm-hmm. And that is all okay if you don't have a lot of debt to carry, but the Canadian households are carrying a significant amount of debt, and that is creating an environment which is somewhat complicated.
So longer term, you're positive on Canadian bonds, but you do have concerns in the near term then?
Well, I would say long term, I'm super bullish on Canada as a country, because there is an incredible amount of potential that the country has. But in the short term, maybe also medium term, I am somewhat concerned. I hope there's going to be a slew of positive news coming from pipelines that are being built and refocusing on the natural resource sector, also with the government support. But short to medium term, I'm somewhat concerned because of growth slowing down quite meaningfully while debt levels being really high. And that is, in my opinion, bringing the Bank of Canada also back into play as a support mechanism that is trying to help the economy to get back on its feet.
So do you think the Bank of Canada will cut in the near term again?
Yeah, so we have nothing priced. So if I look at the implied futures, there is nothing that the market is expecting. And I also don't expect them to cut rates here at the next meeting, and probably not even at the January meeting. But once we get into March and beyond, I'm at this stage, with the information that I have, I'm pretty confident that we'll get future rate cuts. And that's not priced in, which creates an opportunity to make money in fixed income, because fixed income would in general benefit quite a bit if the Bank of Canada were to come back to cut rates. But again, it is not imminent. It is not at the next meeting, probably not at the one after. But coming back in March, I would not be surprised to see 50 to 100 basis points of cuts coming from Bank of Canada.
Oh, that's interesting. But I think reflecting your strategy there, you would favor short-term Canadian bonds then in the near term anyway.
That's right. So that would be anything 2-year, 3-year, maybe 5, also 10 is probably going to be okay. 30 years, it becomes a different story, because the long end of the curve doesn't really trade much based on how much the central bank is cutting rates. Here, you're talking a lot more about debt sustainability and those kind of issues, and those can become a hot spot. We've seen it in the UK, we've seen it in Japan, where at some point you cannot just borrow more money. There is a pay for, and that pay for is either at the long end of the bond curve or through the currency markets.
What is your thought on Japan? We've seen that big backup in Japanese long-term bond yields, the government apparently wanting to spend its way out of slow growth.
Yeah, that is the fixed income market that has been painful for anyone who has been invested in Japan. I'm probably at this stage where I'm becoming more interested in owning Japanese bonds, because the country has to make a decision of whether to support the bond market or to support the currency markets. And given how weak the Japanese yen is, and given how undervalued the Japanese yen is relative to all the other countries, it is hard to imagine that seeing the yen weaken any further is a long-term strategy that will be successful. As such, Bank of Japan is probably being forced to hike rates. So that is different to Canada, different to probably also the United States. So they will have to raise interest rates in order to make sure that the currency is not selling off by too much. So that would bring the front end of the yield curve higher, but would provide some form of stabilization maybe in other parts of the yield curve.
That's interesting. Looking at emerging markets, you say some countries, including Brazil, Mexico, and South Africa, are doing a pretty good job of managing their debt loads.
Yeah, I mean, nothing in absolute terms. It's also not looking fantastic there, but it is. If I compare that to what is happening in developed markets, the gap between emerging markets and developed markets seems to be closing. So it is, developed markets are getting worse faster. So on a relative basis, some of those emerging markets are starting to look quite a bit better, and you get compensated for it, right? So their yield levels are in many cases substantially higher. You're talking about high single-digit yields for 10-year bonds, low double digits, so anywhere like 9 to 12% or so yields for a investment which looks, I would say, reasonable. It does carry some risk. So if there's a major bump in the road in risky assets, so if equities were to take, for example, a 10, 20% dip, of course, those emerging markets would also fall in value. But overall, I think that is a risk that I like and that we're taking in our funds.
And just broadly, Konstantin, what about U.S. bonds, say the 10-year bond in the States? Is that attracting you at all right now?
I would say somewhat boring. There's over the year, there were moments where it was really interesting, really attractive. Right now, we have 100 basis points of interest rate cuts being priced for the next year. Yeah, seems reasonable, seems fair. There are some lingering concerns about the bifurcation of the U.S. economy, where you have some parts doing exceptionally well and other parts not doing well at all. And the central bank is probably looking at the areas of the economy that are not doing so well in order to dictate how their the policy rate will adjust. Therefore, we're seeing 100 basis points of cuts, and I think we're getting a good amount of those in the next few meetings.
Konstantin, thank you very much. Konstantin Burmer, Head of Fixed Income and Portfolio Manager at Mackenzie Investments. Coming up on Hot Picks, we'll look at 3 stocks that could be buys if AI stays weak, if a cloud stays over the big AI stocks. We'll have more after this. Now it's time for Hot Picks. We have seen some of those red-hot AI names coming off their peaks over the past month. Our guest says this creates an opportunity to buy some of these names at a discount. We are joined on this theme of dips to buy in AI by Ryan Modesto, CEO and Portfolio Manager at I2I Capital Management. Ryan, great to see you. Thanks very much indeed.
Nice to be on. Thanks for having me.
Can we jump in and get to your first name, Nebius? It's a cloud infrastructure provider. You see promise here. Why do you like it?
Yeah. So this is a data center company providing GPU capacity to large AI companies and smaller AI companies as well. We like it. They're built a bit differently. We think they're a data center company that's built with AI in mind from the ground up, where a lot of their competitors are more have like pivoted from Bitcoin mining into the AI data center place. So we kind of like the overall setup of Nebius, and their management team has built really large companies before. They're well entrenched in the tech sector, and we think they're well set up to succeed in this space. You know, the thesis here, though, really, I don't want to oversimplify it, but to keep it simple, it's just exponential revenue growth. I don't know if we've ever seen companies or a company or a group of companies that are growing revenues at the rate that this group is growing their revenues at, and at the scale they're growing it as well. In 2024, they did about $117 million in revenue. In 2026, they're expected to do $2.4 billion in revenue. For annual recurring revenue by the end of 2026, they're expected to do $7 to $9 billion in revenue as well. So large numbers. I guess the argument could be, well, anyone can throw big numbers like that. How do you know they're going to act on it? But they're signing contracts that kind of back that up. A couple months ago, they signed a deal with Microsoft for $17 billion. And in the recent earnings, they also announced a $3 billion contract with Meta as well. And they said that contract would have been bigger. They just didn't have the capacity to service anymore at that time.
Your next idea is Ouster, and they are involved in sensors that can be used in robotics. Tell us what the attraction is here.
Yeah, so it's a bit of a robotics, a bit of an AI company. They do LiDAR sensors, and everybody, when they think of LiDAR, I think they think of autonomous vehicles. Ouster can do that in the future, but they're really focused on the robotic side of things. So think of automating your warehouse on forklifts, robotic arms, but also drones and things like that. So we think robotics in the next 1 to 3 years is going to kind of have its ChatGPT moment where everybody kind of says, whoa, these things are going to become real and they're going to be in our houses or wherever. And Ouster has the ability to kind of be the eyes for the robots that allow them to interact and see their environments. They're one of the first companies also to get government approval in the U.S. to deploy their sensors on military, so things like drones, perimeter security, things like that. And their main competitors tend to be cheaper foreign products coming from other foreign companies. And we think down the road, governments are going to crack down on this because there's real security issues, right? If foreign companies have LiDAR sensors all throughout your country, mapping out your surroundings and your every move, and Ouster's US based, so we think they're going to benefit in the future for their kind of geographic location as well.
That's interesting. So the Americans might be wary of Chinese vision equipment spreading through the country because the military, I guess, in theory, could be peeking through.
Exactly. Yeah. So always a risk, and just with heightened geopolitical tensions, we think down the road, in the next year or two, there will be some movements on that as well.
And finally, you've got a company for us called Invent Electric. They're an equipment supplier.
Yeah. So this is more of a traditional capital equipment supplier to the data center space, the infrastructure space. doing cooling systems, things like that. And really, we like this company. They're just doing they're in the right place at the right time, and they're doing all the right things as well. So they have the obvious tailwinds with AI trends, data center. You also have the infrastructure, onshoring and reshoring tailwinds that are helping them out. They've shifted their business more towards the infrastructure space in the last couple of years, and that's helping them increase their margins. They're growing organically in the mid-teens range. They're growing, when you add on acquisitions, 20% to 30% plus. Their margins are improving. They're buying back shares. They're increasing their dividends. And they're actually trading cheaper than most of their peers as well. They trade about 26 times forward earnings, and most of their peers in the space trade at, probably being generous here, but 30 times earnings or above.
It's amazing. I wonder, people supplying electrical equipment or expert electrical contractors in the States, they must be just swamped with business right now.
Well, that's a bit of it's a good problem to have, I guess, but it's a bit of the issue they're saying, right, where demand is far outstripping supply. And like Nebius as an example, they said, we have people lined up at the door trying to get access to data center capacity. It just takes time to build it out, right? And it's supply chain constraints and supply chain issues are really kind of the limiting function right now in the AI space, it seems.
Yeah, I wonder. I'm sure you phone them. They say, "Oh, we might be able to get to you in 2029." Yeah, it is interesting the way the actual electricity is turning into such a potential roadblock here. Ryan, thank you very much indeed for joining us.
Thank you.
Ryan Modesto, CEO and Portfolio Manager at I2I Capital. Up next, we'll bring you the third and final part of W5 John Woodward's report on that Canadian biotech company that says it has been targeted by short sellers. Some investors are calling for more measures to take the profit out of a market manipulation tactic called stock spoofing. As W5's John Woodward tells us, modern techniques are making some investors a lot of money, while authorities are trying to catch up.
Randy Manzardo spends his retirement in Coquitlam, BC gardening. His tomatoes are growing fast. His stocks, not so much. His retirement plans are in jeopardy.
It's disheartening and it made me a bit angry.
He invested tens of thousands in one stock in particular, Quantum Biopharma, believing their drug for multiple sclerosis showed great promise in mice.
When they put these announcements out about how good this was, it would drop. And I've done enough investing that when there's a great announcement, it doesn't drop, it goes up.
Randy thought something was up, and so did the people at Quantum Biopharma. They've sued Canadian banks, alleging their stocks were driven down by a market manipulation tactic known as stock spoofing, demanding $700 million in compensation. The banks have denied this.
Quantum is just an example of what's happened to the whole sector.
Terry Lynch is the CEO of Save Canadian Markets. He believes spoofing is on the rise. Players using computer programs or algorithms he calls algos, faking orders by the thousands to drive stocks down. They profit, he says, by short selling, essentially a bet that a stock will drop.
And it's just they just have algos making, $1,000 here and $500 there and $300 there, and you make it on 200 companies. It adds up to real money over time.
Stock spoofing prosecutions in the United States show that techniques that were cutting edge just a few years ago have now become much easier to do at scales never before imagined. American authorities have been busy. The largest settlement so far, J.P. Morgan Chase paid $920 million to settle allegations of hundreds of thousands of fake orders. They're also prosecuting Canadians operating there. That includes an alleged stock manipulation case of an Ontario man, Alexander Milrud, whose network in Korea was allegedly making more than $1 million a month. And TD Bank paid more than $20 million to resolve charges relating to a former trader's alleged actions. Spoofing is illegal in Canada. Records show the number of proceedings against so-called market manipulators has doubled from just 5 in 2022 to 10 last year. But in that time, total fines never rose above $1.05 million.
What we need is the court systems to send some messages out there to say, hey, we need to stop this. You need to be punished, and now you need to get reform.
Lynch believes another way to stop spoofing is to take the profit out. He's pushing for restrictions on short selling. A report for the Ontario government recommended some short selling restrictions. That was 5 years ago. It's still in progress. We caught up with Ontario's finance minister.
Where are we on those recommendations and protecting investors?
We expect all market participants to follow the rules.
You might be aware of a lawsuit that alleges even some of the big banks were engaging in some predatory practices like stock spoofing. I mean, is it so widespread that even the big players are doing this?
Look, we have enforcement, and everyone's got to follow the rules. I'm not going to comment on anything in front of tribunals or courts right now. But make no mistake, we are always there to protect the good actors and go after the bad actors.
Over in BC, Randy appreciates the sentiment, but he doesn't feel he can compete.
It's such an uneven playing field for average guy like me.
He's hoping his quantum stock turns around because he's not sure he wants to take another risk with his retirement.
So we're getting potential timing now, 11:30 a.m. Eastern Time. Apparently that's when the Prime Minister and Alberta Premier Danielle Smith will make some kind of an announcement on a plan to work towards a deal on a pipeline, a new pipeline to the BC West Coast. So obviously stick with BNN Bloomberg. Where else would you go? In about half an hour's time, we'll get that news. Let's have a quick look at the markets before we go. Maybe we'll check in on the Asian markets. They are trading against the backdrop of that tension between China and Japan. Japan is now denying a report that U.S. President Donald Trump advised the Prime Minister of Japan to avoid provoking China over Taiwan. Remember that the Japanese Prime Minister said that there could be a need for Japan to take some military action if Japan was to attack Taiwan. And that did not go down well in Beijing. Frustrated to hear that. Of course, they don't want anybody talking about Taiwan except themselves. Let's have a very quick look at the TSX, see how it's trading right now. It did push, European markets first, sorry about that. The British unveiling their budget yesterday, not the shocker in terms of tax increases that some observers had been talking about. Let's have a look now at the TSX to see how it's faring, pushing further very slightly into a record territory. Big movers right now. Tilray Brands, always volatile, down 14%. Apparently, Tilray is planning a rollback of its stock. You will end up holding an exciting 1 share for every 10 shares that you previously held. Often that is a sign of a company that is struggling. Of course, the stock last cited at about $1.27 in Toronto. Big traders in big value traders right now. Great-West Life up around 1%. Suncor's ahead. Hot 8, the Bitcoin player, jumping about 4% on big volume and more than $21 million worth of shares traded right now. Thanks very much indeed for watching The Open. Remember, in just half an hour, we're going to get Danielle Smith of Alberta and the Prime Minister making some kind of an announcement on their desire to build a new pipeline, or see a new pipeline built, I should say, to the BC coast. Morning Markets is coming your way next.